Scalping isn't about taking more trades, it's about taking the right ones. If you're still losing money, this video will show you why. Let's meet. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. Scalping is a short-term trade that is expected to make a profit from the fact that the price changes rapidly. Therefore, the time frame that we will use will be from seconds to minutes. Most of the time frames that I choose to use will be 1-minute time frames and 5-minute time frames. Scalping will focus on speed, accuracy, and most importantly, risk control or set stop loss. The example will be like this. The graph is the base market before the first period. You will see that the graph does lower high all the way. When it reaches a point, the price goes back. The point that goes back, we will look for the market structure shift, or the price has gone up the latest. When the price changes, we can use price action to help enter the trade. When the price goes up for a while, we may have sold out. We look for a new entry point, a short trade. This kind of trade is suitable for a market that is competitive. If you want to buy, you can buy. If you want to sell, you can sell, or what we call high liquidity market. Today, I have a trading technique that I have tested 4 types to share with you. The first type is called previous day false breakout. The first step is to look at the graph. The line that you see now is the day. The distance between one line and another is 1 day. Therefore, I call the left day as yesterday and the right day as today. This technique, we will use the information from yesterday to enter the trade today. The information used yesterday, we will look at the highest price and the lowest price. So I call it previous day high and previous day low. In these 2 lines, most traders will see it as a positive and negative trend. Therefore, if the price bounces or bounces out, it will be a very good entry point for trading. Next, when we get high and low, we will start to look at the market today. When the price opens, there is a chance that it will go up or go down. In this example, the price goes up. Therefore, I will continue to draw this line. When the price goes up, we have 2 to 3 choices. The first choice, we can trade breakout, or the second way, wait for it to pull back and bounce up. But for this case, we will not trade breakout. We will wait for the price to rise and turn into a false breakout, and we will wait for the price to go back down. At this point, the main part of smart money is the liquidity sweep. The big line pushes the price up and pulls it back down. Therefore, we will wait for the trade to follow the big line. When the big line pulls the price down, we can open the shot and the price will have a chance to go down for a long time. Let's take a look at the example. The first example, you will see the line. Left hand is yesterday, right hand is today. Yesterday, there was a high point around here. It fell out. Friends will not see it, but I will draw a line for you. When we start today, we will keep looking at it. After a while, the price breaks out, has a pullback, and goes up. If you enter this trade and exit quickly, you may get 1 profit. But for this policy, we will wait for the fall breakout. When the fall breakout occurs, the price will go back. We will not trade breakout and we will not trade pullback. We will wait for the price to go back and become a reversal. After the liquidity sweep, we can open the shot and the price has a chance to go down. Let's take a look at the example. The first example, you will see the line. Left hand is yesterday, right hand is today. Yesterday, there was a high point around here. It fell out. Friends will not see it, but I will draw a line for you. When we start today, we will keep looking at it. After a while, the price breaks out, has a pullback, and goes up. If you enter this trade and exit quickly, you may get 1 profit. But for this policy, we will wait for the fall breakout. When the fall breakout occurs, the price will go back. We will not trade breakout and we will not trade pullback. We will wait for the price to go back and become a reversal. After the liquidity sweep, we can open the shot and the price has a chance to go down. Friends can close the shot as quickly as possible and get full profits. At this point, you can use other indicators to build a trade. The indicator that I recommend is to look at the volume. When the price breaks out and it goes back, the volume should be very high. This indicates that the market is ready to go down. When we look at the volume is a lot. We can open the shot comfortably. The third example for the first example. As usual, we have yesterday and today. Yesterday, there was a low point at the bottom. When it opens today, the price is still for a while. Finally, the price decides to go down. When it goes down, we wait for a liquidity sweep or a fall breakout. After the sweep, we wait for the price action signal. In this place, it is very clear. You will see a bullish engulfing. Or even better, it is a three-line strike. The price goes down because of the 3 chains attached, but there are 4 chains that engulf or swallow all the chains before the face. Therefore, the market has risen to the full. You can buy in and the price will go up for a long time. The next example, it's still the same idea as yesterday and today. Yesterday, this point was the low point. Therefore, there will be a previous day low around here. When the price opens today, it seems to go up a little bit, but it went back down, the test that has been accepted many times. Finally, the big line pushed the price to hit the Yoi's stop loss. When the price is pushed down, all the graph liquidity is a fall breakout. Finally, he pushed the price back into the same range. We can buy according to the big picture. The second, third, and fourth strategies will be all pullback trading, but there will be a point of reference and different trading methods. The first method I named first pullback. The principle will be like this. The price goes down first, doing a lower high and a lower low. When it reaches a point where there's a market structure shift, the price goes down and becomes a rise. When the price falls here, we will not enter the trade yet. We will wait for the price to go up and then move back. When it comes back, we will only be interested in coming back for the first time. So I call it the first pullback. When it goes up for the first time, we look at the price action to enter the trade. And when we enter the trade, it seems to be the beginning of the trend. The price has a chance to go up after we buy. Let's look at the example of the first pullback. On the left-hand side, you will see that the price is falling. The price has been making a lower high all the way to the point where the price has fallen the most recently. There is a market structure shift. We don't trade breakout. We will wait for the price to make a first pullback and then come back to the original trend, which has now turned into a trend. When the price goes up again, we will look for a suitable price action to enter the trade. There are many ways to change the time frame. Look at the chart pattern. Look at the skyline graph. After watching and being confident, you can buy. After buying, the price has a chance to go up for a long time. Another example is still the same. The left hand is a long down market. The price made a beautiful lower high until it reached a point where the price went up. At this point, the market structure shifts. We will wait a while. When the pullback price comes back, we will find the time to enter the trade as before. This gold bar is a hammer. I can say that there is a lot of buying power, but due to the fact that the graph is not yet confirmed, we will wait for a while. When the price is small in the first pullback, we see bullish engulfing along with a long trend. Therefore, we can trade in this area or wait for the price to hit this high. After buying, the price rises rapidly. The third example of the first pullback. The market will rise and fall. The left hand is the market to rise, do higher high, and do higher low. We will wait for the price to come back. The latest high, which is in this area. At this point, there is a market structure shift. The price has a chance to go down, but we will wait a while. Wait for the first pullback. There was an increase in the first time, which in this area, it also increased to this area. In this zone, we can find the time to open the shot. After opening the shot, the price will have a chance to go down for a long time. From this example, I'm sure. Wait for the price to hit this area first and then open the shot. But some friends may zoom into this area and open the shot faster than this. The last example for the second factor is the uptrend market, going back down. The price made a higher high and a higher low as before. When the price can't break high, there is a recent low return, it becomes a market structure shift. At this point, we don't trade breakouts. If you trade breakouts, you may get profit. But in this case, We will wait for the first pullback. Wait for the price to come back, adjust. After adjusting to be sure, the price has a chance to go down, back to the bottom. We can open the shot. This pair is bearish and carving. The price has a chance to go down. The third technique is the pullback trade that I like the most. That is VWAP bonds. If you follow this channel from the beginning, you will understand how much I like this indicator. VWAP comes from volume weighted average price. Mainly, it is a ratio that takes the amount of buying and selling into account. Similar to EMA, but better, because there is a volume come in and weigh it. The way to look at it starts from these two lines on the left hand, which is a new day, and the right hand is the end of the day. Therefore, from left to right, it is one day. The blue line is the VWAP line. When the day is over, it will reset and start a new calculation at the beginning. Friends may wonder that, why does this line suddenly rise strongly? Actually, it doesn't rise. When it runs out and starts again from the top. The basic view of VWAP, we will look at it like this. I would like to divide the graph into two parts. On the left-hand side, the price will be below VWAP mostly. When the price is below VWAP, it is said that it is a down market. But when the price of VWAP is up, now the price is on the top. When the price is on the top, it is said that it is a down market. The VWAP trade method that I like to use will be like this. But for today, I will only pull one indicator. That is, pull back to VWAP and bounce up. The principle is that we will wait for the price to run away from VWAP first. After that, there will be a return. When the return comes back, the test at VWAP, we will find an easy time to enter the trade. Look ahead for a while, the price will go back to the test at VWAP again. After the test, we will find a new time to enter the trade. And the price action that I use to confirm the easiest is bullish engulfing. When we meet this pair of gold bars, the green one is closed, eating the red gold bar. You can check it out. The left hand is bullish engulfing. We can buy when the bar is over. When the price goes up, we will close the scalping trade and get full profit. The price goes back again. Bullish engulfing occurs again. We can buy, and the price goes up to profit again. The next example, the idea is the same. The price went up in the first period. After that, try to escape from VWAP. Wait for the price to come back to test at VWAP. After the test, look at the price action. Grab this pair. In this case, in addition to bullish engulfing, it's also a free line strike. So when the price is over, we can buy, and the price has a chance to go up for a long time. The next example is the market going up and going down. At first, the price went up first. After that, there was a return to VWAP. At this point, the mouse area that I pointed out, basically, we will wait for the price to test and then go up, right? But in this place, the price is falling. There is no bullish engulfing. Therefore, we let the price fall further. When it falls, we will have to change the perspective. From trading up, now it will become a trading down. And when the price goes back, this area is a test of the resistance. It is a test of VWAP itself. Therefore, we will look for a chart pattern that can be used to confirm entering the trade. And of course, it will be a chart pattern that is bearish engulfing. When we find bearish engulfing, the price has a chance to continue through the game. We can open the shot, and the price also has a chance to continue for a long time. Scalping trade is a fast trade that can go out quickly when the reward-risk ratio reaches the target we want. The last example of VWAP is complete. Left hand is a rising market. There is a rise to test at VWAP. After the test, look for bullish engulfing, immediately found. Considered to pass the gain. After passing the gain, we can buy it. After buying, we sell it on the top, and we wait for the price to rise again. But this time the price rose back down. Therefore, we will not buy this trade, because there is no confirmation that the price will bounce up. When the price goes down, we look at the stock market instead, and the price went back to the test at VWAP. After the test, no more power. Can't go on anymore. Turned into bearish engulfing. We can open the shot, and the price has a chance to go down for a long time. The last advantage for trade scalping, that I tested and got good results? That is pullback. To fair value gap. Fair value gap. If you were in the smart money concept line, you will know fair value gap very well. But for those of you who are not in the SMC line, I have a short review for you. FVG, or fair value gap, is when the price rises or drops rapidly. There is an empty space of price. In this area, when the price moves too fast, the price you see may not be the price it should be. For example, there is a price shift, or it may be good news or bad news, causing the price to rise due to panic. It looks like this. There are 3 bars. The first bar is still normal. When you find the second bar, the price rises rapidly, creating a fair value gap. At this point, we will measure from the high point of the first candle to the low point of the third candle. And in the middle, it is a fair value gap that the price rises rapidly in the second candle. The price goes down, it's the same. It's a candle that goes down first. After that, there was a severe price drop, which turned into a fair value gap. When we find a fair value gap, we will use this principle. The market will try to adjust itself to bring the price back to the price it should be, which we call this price the price that is done or the price that is correct. Fair value price. Therefore, the way to enter the trade is not difficult. We look for a market that is up first. There is a fair value gap around here, and we know that the price has a chance to come back. Adjust to the price that is done. When the price is adjusted, we can buy and hope that the price will go up for a long time. There are many ways to buy. You can buy it from the first time the price hit or buy it in the middle of FVG. If you are experienced, you may zoom in, change the time frame to be more detailed, find a better time to enter the trade. Let's take a look at the example. This example, you will see that the price is high. When the price goes up, at one point the price rose rapidly. In this area, a fair value gap occurred. Measure from the first to the third bar. When we get FVG, we just wait. Wait for the price to come back to FVG. When it hits, we can buy, and the price has a chance to go back up. The next example. The left-hand side looks like a sideways market, but if you look at it in detail, it will be a chart pattern that has momentum build up. This chart pattern is the ascending triangle. The price tried to go high many times, but couldn't. At the same time, the price began to accumulate power by raising the low. Therefore, the price has a chance to break out and go up for a long time. In this place, the price breaks out and rises rapidly. We will get FVG around here. Wait for the price to come back. Wait a while. The price will adjust to the price that should be. We can buy, and because of the momentum from the beginning, it's been up all the time. So when you buy it, you can be sure that the price will go up for a long time. The third example is to go back down. The left hand is a sideways market. It's a consolidation. The price won't go down. It won't go up. It won't go up. Until one point, the sales side is the winner. The seller pushed the price down heavily. We can find FVG. After we get the fair value, we wait for a while. Wait for the price to come back and touch the FVG. After touching, we open the shot, and the price has a chance to fall far away. The last example is the market. There are 2 points of FVG. If you can block the time, you will get both profits. The first step, you will see that this area is a low point. It's a low over low, and in the meantime, there was a sharp rise in price. In this area, we got a fair value gap. Wait a while. The price will come back to the fair value gap. We can open the shot. Open, and the price goes down. Get a full profit of 1. And when it came down, the price went down again. The latest low turned into a lower low. In this area, we can find a fair value gap. And finally, the price went back to this fair value gap. When the price closes the gap, the price enters the balance. It will choose the side. In this place, we open the waiting spot. Because the market has been down for a long time, I hope the price will go down. Finally, the price really went down and got the second profit. All of this is the scalping trade that I have tested. There are 4 methods that have the best results, and I like them the most. The first formula is the fall breakout. The other three formulas are all pullback trades. Friends, you can try to test to see which currency is suitable for the asset that you are using. And how do you get the result? You can tell me in the comments. See you in the next clip. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you.